Hello and welcome again. This is Robert Schein, Managing Director Partner of Blanke Schein Wealth Management. Today is May 12th of 2022 and markets continue the sell-off. Markets have been selling off obviously since last November, year to date, and now last string is like 6 trading sessions in a row. We haven't seen that in 11 plus years. So making some historic moves in the market. Now, a lot of questions are, hey, listen, is it oversold, if you will? That's really the question. And what markets we look for in terms of market bottoms, you really can't ever tell or call it or predict it. And that's why you basically say, listen, we own quality, we're balanced, we're diversified, we're also taking advantage of when markets give us opportunities and putting money to work. And one of the things you want to look for is the VIX, the volatility index. Is it close to 40? And that's usually when everyone says, hey, listen, I'm out. Institutional retailers are saying, listen, it's basically waving the white flag. Unfortunately, the VIX is not quite there yet. We're in the mid 30s. We need it to go to the 40 level for this to actually shake out or for the market to break its fever. That being said, there are a lot of people off sides in the short side. So that means that when the market sort of continues selling to the downside, and then all of a sudden you get one positive sort of news or some change in sentiment, markets then can rocket back up even higher and quicker and faster than you actually think, because the shorts have to cover. So you get this accelerated buyback. That's why we say, listen, we're not traders, we're investors, and we're looking for the long term. And so long term, we're actually looking at the balance sheets of corporations. Now, margins are under attack. And why are they under attack? Well, obviously because of wage inflation and all of the inputs, like the inflationary pressures that we discussed. And also, if you have sort of international currencies, we have this strong dollar, and that's putting pressure around the globe. It's not just the US, it's every asset class everywhere. So all assets are under attack, and the question is it sort of margin compression? And that's what we're seeing. But we look towards earnings, and at the end of the day, the word is the market is detached from the earnings. Now, obviously margin compression, right? So the multiple compression that we're seeing right now is playing out in the market. And the market's really trying to guess, which is an unknown in the future, where we're going to land with regards to where interest rate levels will land and where margins will actually be, or earnings. Now, if you recall and been watching, our earnings season was better than expected, about 12.6% ahead of what we actually anticipated. So earnings grew. And how do we know this? Well, last year's earnings for the S&P was 208. Right now we're 227 estimate. Could be 225 by the end of the year. We don't know. And that's really what the question mark of what the market's trying to figure out. At the same time, in this global sell-off of all assets that we're seeing, we got to say, hey, listen, as prices come down on equities, the yield or the dividends are still the same, right? You can't fake a cash flow. You can't fake the earnings that are happening. And those dividend yields are getting higher, and more attractive. So at some point in time, it will be oversold. At some point in time, we will see the reversal of the trend of this downtrend that we're seeing. And also, one of the key indicators, maybe not the VIX right now, is showing that the equity markets are basically done, but the bond market actually had a significant reversal on Monday. It hit and peaked at the 320 level for the 10-year U.S. Treasury. And as of today, right now, we're at 284. So we've backed off significantly. So is that a recessionary indicator saying, hey, listen, the markets are going to have now stagflation because we have inflation coming in on all the inputs. We have margin compression on the earnings. And then we also have goods and services, right, are just being priced wherever, and we have a higher than what it was yesterday in terms of what we're paying for, food, energy, so on and so forth. And then we also have at the same time a global recession, right? So the growth is slowing while you still have inflation, sort of 70s style. That's the fear, and that's what markets are sort of working through right now. But again, we're balanced, we're diversified, we've got cash to put to work, we're being patient, cautious, but we're also saying, hey, listen, once we believe that we're getting closer to having this behind us because of what the 10-year Treasury is telling us. And as you know, we've been following the 10-year for this whole time. So the 10-year sold off, and usually the bond market precedes what the equity market's going to do. So it's a pretty good indicator. So we don't know. We're going to find out as this plays out. But again, what we're seeing in terms of selling in Wall Street, those that need to sell. And our clients don't need to sell because we're going to see markets, we believe, higher by year end. So that's our update for today. Thanks for watching, and we'll see you again next time.